So I guess I would say this economy is very strong, and what's driving it now is just a very strong labor market. There's still significant demand for workers. There are more job openings than there are unemployed people. Wages are moving up, and that's really what's driving the economy forward. People's disposable incomes are coming up. Inflation is moving down gradually. The thing that troubles people, and I think the thing that accounts for the surveys you see where despite a historically strong labor market, people are still concerned about the economy, it's really inflation. So this is our job, is to bring inflation down. The way we do it is by raising interest rates. And while that can be painful, what it does is it gradually slows down demand so that supply and demand can get back into alignment.
We've been in over 200 days of a bear market, meaning that in the S&P 500, from high to current, we have not surpassed that high, therefore rendering us a bear market condition over 200 days, which is actually historically one of the longest bear markets that we've had. And we, over the last 8 months, have been in a bull market. So it's kind of like one of those weird questions. I have people, in fact, I used to do surveys in large rooms where we would ask someone, S&P 500, how many of you are a buy? How many of you are sell? And it's like generally no more than 60-40 or a 10% difference between the two, meaning that there was generally the room is split. And I would say that both people are right? Have we been in a bull market? Yes. Have we been in a bear market? Yes. But will this bull market pull us into a bull rally? And will we see higher highs than we've seen in the past from the pandemic? And I have a lot of data to go over with you to create an argument both ways. I don't know how many of you guys know me personally, but I'm actually a debater personality. ENTP is actually the Myers-Briggs personality code. I think it's Myers-Briggs. But ENTP, I can't remember, I'm like plus or minus at the end. But basically, it's the debater personality type. And so one of my skill sets is I actually naturally can take both sides. And so I'm going to make the argument for a bull rally. It does not mean that I'm making my trades based on that, just like the disclosure. Obviously, this is not trade advice. And then I'm going to make the argument for the bull continuation, because I think it's valuable to see both sides and get the weight so that you know what indicators to be watching for as you're balancing your own investments and your own trade portfolio. All right, so let's go ahead and jump into training on the bull market. And I've got this little sheet I pulled up with the help of a couple friends, Bloomberg specifically, I think market trends. I'll quote them as they come out. But some of these charts I've gotten some help from. And I want to show you guys this bull market argument. And what I'm pointing to is the S&P 500. The S&P 500 enters a technical bull market territory return since 10/22/22. So this goes way back into October. It's about an 8-month bull market rally. And you can see that the NASDAQ has come back 27%. The S&P 500, which we'll be focusing on today, has come back 20%. The Dow's come back 16%, and the Russell 2000 has come back 11%. And so it's clear to see that your smaller cap companies are definitely not winning the bet in terms of growth. Russell not showing that much strength, but it is the larger cap that's kind of pushing the S&P 500 back up. We'll talk about that in just a second. But this is positive for the market. This is a positive climb. And with some of the stuff that happened this week, one of the things we're going to be talking about that could potentially continue to help this bull rally is we just did a pause on rate hikes. We just had one of the largest drops in inflation since inflation went over our kind of normal 2% rise. We just had one of the largest drops on inflation. We're seeing decent CPI. Unemployment's holding up. We're going to talk a little bit about unemployment also today. But generally speaking, this soft landing that the Fed said that they were targeting, it's starting to look a little bit like a soft landing. It really is. This is not a 2008 crash so far. We haven't had any major surprises that the Feds, combined with some help on the political side from Congress, hasn't been able to navigate and say, let's put some policies in place to create consumer confidence. Because really, I would say the stickiest thing that holds this whole thing together is the confidence of the market. And we've been able to portray and instill confidence in the dollar, in our monetary system, and that the Feds can actually tame this beast called inflation. So this is all really great news. Now, if you go in for duration, this is where I kind of go, okay, I get it, Edward Jones. I see they're the ones that kind of came out with this data. It's like I can kind of see your argument, but it's not as strong as I'd like to see it. It's showing some signs of a turn, like an indicator of like this could be a possible bottom. But this doesn't make a very strong argument for me. What you're seeing here is this image. The graph on the left shows the duration of historical bear market rallies that have lasted on the average of 2 months. So you can see kind of here's your 2-month average right above 50, right? It's like at your 60 days. So the average bear market rally since 1920s has been 2 months. You can see that we are way, way, way overdue. Like, what does it say? 240. So we've been in a 240-day bear market rally, which is really long. Granted, we've had a pandemic, massive pump of cash into our system, went through the roof, the highest historically ever in our country. So to see these type of bars after that much cash being poured in, we're gonna have to get used to this until things kind of stabilize into this soft landing that Jerome Powell has kind of set out for us. However, the graph on the right shows the market gains during the first 8 months of the bull rally. And so the gain, and you can see that the average is around just under 40%, and we're not quite seeing that number. In fact, it's the second lowest so far, if this is where we end up capping out. 14%. But again, actually, let me take that back. This is an 8-month read. So for an 8-month read of a bear market, like, hey, we're heading into this new bear market territory, this is the second to lowest growth we've seen in an 8-month bull run, you could call it, or a gain on the S&P. So not exactly ecstatic about this. We had better returns and better runs in that first 8 months in 2009 after the major recession that we had during 2008. So this isn't exactly a good sign that maybe this is the year, or 2022 is the year. We might see it in 2023. This does go from 2022 to 2023, by the way. Let me show this. So this is the S&P 500. I've got GreenCharts loaded, and I've just stripped this to make it really simple to see. But this is the S&P 500. This is why we're talking about the bear market. You can see this week the amount of return that we had. This is a great curve to see for the S&P 500. We had lots of positive news this week. The pause from the Feds helped with this significantly. I'm obviously not a big fan of the one-day hammer that's ending on Friday. For those of you who study candlestick patterns, this is obviously not a great sign. But having said that, if you go back and you look at these time periods, the first time period we were talking about was this 240-day bear market. So what does it actually what is it referring to? Well, it's referring to this. It's referring to, and I'm just going to draw a line here, that we're in a general bear market, right? From the high of last, some people are even saying October, which was like back into here, because that was when the last price was around here, so October-ish. But from the high, you can see that, even since December, we've been in this bearish market, and it's lasted a very long time. Now, having said that, if you look at October of last year, you can see that over the last 8 months, we've been in kind of this bull market. And so it's really easy to see. In fact, I generally like to draw channels when I do this. Let me just kind of show you how I would kind of map this out. Generally speaking, you can see here's our channel over that 8-month period, or excuse me, that 200-day period. Here's our channel for this small 8-month period. This goes back, by the way, all the way into here. Goes back all the way into there. And so you can see here's that 240-day period, here's that 8-month period. And so looking at it from a chart viewpoint, you go, yeah, I could see what it's talking about. This could be a strong sign of us going into a bear trend, or excuse me, a new bull trend over the last 8 months. However, it's the weakest one we've had, second to weakest retracement or start of an 8-month bull run that we've had since, I think it was 1920s. Wasn't that the quote? Since 1957. The only time we've had an 8-month bull market run percentage return that was lower than this one was in 1957, and it was a 14% return. So this isn't a great, it is a sign, right? It's like, hey, pay attention to me, but it's not screaming at us like, hey, this thing's really happening, this thing's really going. And what a lot of people are saying is this is actually kind of the markets today. After COVID, after all these rate increases, massive M2 amounts in the market, this might be how the market settles, and it's going to take longer. We're going to see longer bear markets and longer bull markets as we figure this out, which is actually a reflection. Give Jerome Powell some kudos here. You've got to give him some credit that we are kind of soft landing this massive issue called the pandemic. So my hat goes off to those guys working the big numbers. This seems to be somewhat of what I would consider a soft landing if we don't go into some major recession or bank failures going into the future. So going back into this, just to continue my argument, and again, you can tell I'm pretty good at arguing either side of this. We've got to talk about what's going on with cash. And I've been studying this chart since the pandemic because it was the one variable that I knew we would have to include when kind of surveying all of the other markets, right? Because if you're using your typical indicators like CPE or PCI or gas prices or just the inflationary numbers, that wasn't enough. Why? Because there was tons of money injected into the market because of the pandemic. So what this chart describes, and I'll just read the chart description. The graph here is the savings that households accumulated after the pandemic. So this is money that people accumulated after the pandemic, and we estimate that 40% of those excess savings still remain. So of all this cash, all this M2 that got thrown in, it's important that that burn rate's happening, but it's also important to note that like how much cash is actually sitting on the sidelines right now. Like people have pulled the money out of the market. That's why we're in this kind of bear market. They pulled it out. They've got it hidden under their mattress, so to speak. That was a common phrase we heard back in 2008. But they're, in a way, hiding the money under the mattress. Well, how many people are actually doing that? Well, according to this chart, across America, 60% of those savings that were injected through stimulus, injected through pandemic relief, whatever, is gone. 60%. And 40% remains. And there's a projection. This chart doesn't show it, but my guess and Bloomberg's and Edward Jones' guess is that it's in concentrated amounts in high-income households that are actually less likely to spend them. They will more likely hold on to them. And so that money is likely going to go sit in the market, or it's going to go into bonds, and they actually don't need the money. So we've got 40% of the funds still out in the market. Where are they sitting? Higher income houses, higher income families. So people are padded right now, especially high income homes, around handling the next pandemic, or the next recession, which could actually make things worse. And here's why. There's some things that concern me about this graph. One is the Feds are doing everything they can right now. In fact, maybe we should show this chart, but I just want to show you this chart really quick. But if you go to M2 money supply, and I just type in M2 money supply, you go to the Federal Reserve Bank chart, you can see last year we talked about shredding money. And for the first time in a long time, we've actually started doing it. This was the COVID response, this massive jack up in cash that hit the market. Some of this during the later years was us bailing out the banks. And then now finally we're shredding cash. And that's actually just a reaction to us increasing interest rates. Now banks aren't lending as much. And so this isn't like literally we're shredding money. It's the amount of cash supply available because of credit increases. The banks are lending less. And so we're seeing a contraction in money supply because of that. That's how our banking and money supply system works, is through this printing through the banks and leveraging cash through lending through the banks. So is it working? Yes, it is working. However, we have people, like we talked about in this chart, we have people who are holding their cash and they're not spending it. And when we send a bunch of money out to the public for spending and then it doesn't get spent, that's a problem for getting the market back on track, because consumers aren't spending. They're not dropping money in, which is a good thing for inflation, but it's a bad thing for the markets. We really want this money to go back into the markets, back into helping gross domestic product and PCE. So kind of I'm kind of neutral on this chart, but good to know. Last but not least, again, from our good friends at Bloomberg and Edward Jones, this is a chart that has to do with employment. And this is showing that things are normal. They're normalizing. They are getting normal. The graph on the left shows the number of hours worked has been on a downtrend. So this is weekly hours worked. And as quits rate on the right, both suggest that the labor market is starting to normalize. Trust me, as an employer for multiple companies, I know this. And if you owned a company or you have a small business that you're running, even working somewhere else, you likely got a sense of like the supply demand around jobs got really insane during the pandemic. It was, in fact, I heard stories of people who were like developers who had 8 jobs, and these companies didn't even know. They couldn't even figure it out. And so this guy was out there running, $150,000 salaries for 8 different jobs. And it took him 3 to 4 months to even notice, right, that he wasn't being productive. That's how intense the labor market was. Well, things are contracting. And what this chart on the left shows us is that the amount of hours the average person is working throughout the week has significantly dropped. It's gone from 35 hours all the way down to 34.3, which is more normal. It's what we're used to seeing pre-pandemic. Obviously 2008, we saw that drop into the 33 range, but it is starting to normalize. So people are looking at this data, they're looking at the data before, and they're going, oh, this is all good. These, obviously seeing the weekly hours drop, that's good. Seeing unemployment start to tick up, that's good. These are all good things if you're trained in the market, if you understand how inflation works and getting things back on track. However, if these trends continue, if this trend continues down below this range, below the 34.3 level, now we're heading into a scary territory, a territory that's going to smell and feel a lot like 2008 and during the pandemic. And right now, we're not seeing any signs of this coming off. So you want to be watching US weekly hours chart to kind of get a sense of how the market's going to be reacting over the next couple of months. And then we have US quit rates. These are people who are quitting their jobs. Obviously, we had a massive fallout in people quitting during the pandemic. COVID got people scared, but we're actually starting to see that same type of numbers happen now. The quit rates are starting to decline, meaning people are holding on to their jobs. Typically, people quit because they got a better job offer somewhere else. That's where you see quit rates go up quite a bit. And so as quit rates went way up during here, we saw the job market get really tight. It was really hard to hire. Rates and job prices and salaries had to go up. So a lot of times people were getting higher salaries. But now that this is dropping off and starting to become more normal or normalized, we should see the market settle. Now, again, this is like soft landing territory over here, but what we want it to see is go sideways. We don't want to see this go continual. And it's really hard to stop the momentum on certain things like this. And that's where Jerome Powell and the Feds are going to have a hard time, using their limited tools to get us to bounce back up fast enough, because interest rates typically take 12 to 16, some people say 18 months to become effective. And so the pause that we just did was for a year from now. The rate hikes that we've already done, we are about to feel the effects of. The largest hikes happened just under a year ago, and we're about to feel what that's going to feel like coming into the fall. But so far, there's a lot of confidence in what the Feds are doing and what the markets are doing. And I just pulled up two charts to show some similarities in the S&P 500. So I've got on the top the S&P 500. This is a chart that goes back to the 2008 crash. A lot of people are comparing the markets, comparing how it reacts, contracts, volatility. I follow the VIX quite a bit. That wasn't necessarily a popular chart or chart that even existed back in 2008. But you can watch those things now and get a better idea of what's going to be happening. Now, this is 2008. You can see from the high to the low, there was massive, massive correction in the market. And before the massive crash in 2008, this is what it looked like. So before this is pre-crash. So this is like 1400. You got to remember the market hit like 800, I don't remember what it was. I remember trading on that day, actually. I think it was like 700 and something the market crashed to late 2008, early 2009. But you can see here in May 2008, things were rebounding. Things were looking great. If you remember, unemployment was looking good. The housing market was the tightest it had ever been. In fact, if you look at housing market data in May of 2008, we had like the tightest market that we had ever had, meaning that there was the most limited amount of supply in the market that we'd ever seen. There were less houses for sale. All the conversation about, oh, this is a buyer or a seller's market, blah, blah, blah. It's all the same rhetoric, all the same dialogues, very similar data. However, before the market crashed, we had a 50% retracement from high to low. So from the high to low, it actually retraced about 50%. Where you can see here, this is current data. This is today, S&P 500 from low to high. And we have already come above that 50% low retracement level. And so to say that we're in the same place is really difficult because a lot of this money that's propping the market up goes back to this. It goes back to this data. We had tons of money in people's savings that went out into the market. People felt cushioned. People that had money in the market had nowhere else to put it. And when inflation, you don't want to have your money in dollars. You want to put it in a company or in bonds or in real estate or something, right? And so a lot of these people were given money to manage. And if you guys heard of my last podcast session, I talked about, in fact, I did a 6-minute short on this. You guys can catch it in our YouTube channel. But I did a 6-minute short that actually talked specifically about this data. It talked about how the market was contracting, going back up, but we have this really unique problem today where the amount of cash in the market is kind of propping things up. It's holding things in a position that we're not used to. And so we have to account for all this extra cash that's in the market. And one of the biggest problems, and Charlie Munger, Warren Buffett have both warned us about this, is when we have all this extra cash, what did normal people, as Buffett says, dumb people do? They hand the cash to a hedge fund manager. So they go give their money to someone else to go manage their funds. And then what is a hedge fund manager forced to do? Well, they're forced to trade. They have to, because it's their fiduciary right. And there's some debates around this, but their job when you give them their money is what? It's to get a return. So if you give them your money this month, and let's say that they're actually smart and they're like, we shouldn't put money into the market right now. It's too risky, too volatile. If this were my money, I would be waiting to buy into a better position. If they were to actually do that, you would be complaining to them about like, why didn't you use my money? Why am I getting 0% return? You guys are just sitting on my cash. You would take your money and you go put it somewhere else. And so there's kind of this bad behavior that's inherent in hedge funds, inherent in money management accounts, or in the money that you give to other investors. And it is that they want to get a return for you, and they have this competitive proposition that they have to do it now. And so all this extra cash got dumped into the market, additional funds got added into hedge funds, and so they're forced to buy. And so what's actually unique about some of these charts is this S&P 500. On the S&P 500, one of the things that I would remark on that I think is important to note is the funds that are happening in this chart, the funds that are causing this difference between 2008 and today. And, let's just not even compare it to 2008, but let's just talk about today. I would say one of the biggest reasons we're seeing this cash influx is because we had all this cash dumped in during the pandemic. The pandemic money got put into the hands of hedge fund managers, and the hedge fund managers have to trade it. They have to put it into something. So what are they putting it into? And I think this is important to note. They are not putting it into small caps. I'm not saying that some of that's not happening, but on a large scale, most of this money is going into the top 10. The top 10 stocks in the entire S&P 500 are actually creating this eight-month gain. If you look at smaller cap stocks, you can actually see it in the numbers here. Smaller caps, where was that? The Russell 2000 only got an 11% gain. Now, the Russell includes some of these larger caps, but when they take the average of all the small caps, these smaller publicly traded companies, the gain isn't as high. And so this does show to me, and if you look, by the way, if you look at PE ratios, which is like the actual value of a company, if you look at PE ratios for some of these stocks, AI definitely included in this, the ratios are insane. No day and no way would Warren Buffett put his money into any of these stocks. And I think that's why Charlie Munger and Warren Buffett are taking this position and really speaking largely to how dumb investors are right now in the market, and how that creates massive opportunity for investors like you and I, because you and I can pivot. We're not forced like a hedge fund to put our money in the market today because I have to prove to my investor that we're doing our job. Your main job is to protect your wealth. Your main job is to grow your wealth. And so you don't need to worry about the things our hedge funds are doing, where a lot of us feel like, oh, I just want the peace of mind, give my money to someone else. Just so you know, that's the pressure they're feeling right now. And I think it's actually pumping the market up.